How are insurance premiums determined? Well, my first question is, how do you make reading an encyclopedia a desirable thing to do? An easier question is, how do you make a bland dish tastier? Well, the answer to the second question for a lot of folks would be simply add salt. As for making reading an encyclopedia a fun or desirable thing, I really don't know. I guess it would be different for everyone. Anyway, this question of how do insurance companies come up with the premiums that they charge for insurance policies that they issue is one that comes up a lot in this particular niche. So I'm going to address it here and hopefully present the answer in a way that makes sense and isn't too dry to swallow. Obviously, we're dealing with numbers here, and numbers or math aren't typically high on most people's list of things they consider fun or entertaining. So I'm not going to present formulas or equations, just the general explanations in the most relatable way that I can. Allow me to introduce to you the famous and scintillating actuarial science. I was going to say that the root of actuarial is actual, meaning the real deal. But while that does make sense in a way, it's not true. Actuarial comes from a Latin word that has no practical value for you or me. So never mind that. And you may ask, well, how exactly is actuarial science famous or scintillating, as I introduced it a minute ago? Well, I just found out that there was a study conducted by a job search website that ranked actuarial science as the #1 job in the United States based on income, employment outlook, physical demands, and stress. Unbelievable, yeah? Okay, so actuarial science applies math and statistics to determine risk in insurance, pension, finance, investment, and other industries. More generally, actuaries use mathematics to figure out uncertainty and life expectancy. You can see how that applies to life insurance, right? After all, life insurance is basically a contract to take on the risk of a person dying for a price. Well, how risky is it that a particular person will die within a specific time frame is a big part of that. The other big part is how much does the contract require the insurance company to pay when that person dies? How those risks are determined is largely by the use of the law of large numbers. Wait. It actually makes good sense. The law of large numbers just takes a large number of people, say 100,000 people. It's a fairly large number, yes? So let's say all those 100,000 people are males living in Hawaii, and they're all 35 years old. And they all work in an office environment, and they're all married and have one child. There are statistics that have been recorded and can be referred to. And with that combination of information, an actuarial, a person who applies actuarial science, can figure out the average age that those people will die. That's called the mortality rate. Now, if all those guys worked in construction and smoked tobacco, that average death age will be different. Throw in any other changes, and that death age may likely change again. That's basically the law of large numbers at work, because we're looking at 100,000 people, all with the same circumstances. Makes sense, right? There are statistics for every imaginable variation of conditions. Let's say all these guys are 45 instead of 35, and they do extreme sports for fun. You think the mortality rate might change a bit there? Now, with the different types of life insurance, whole life, term, and universal, there are additional factors that influence the premiums charged. For all types of insurance, there are four main factors that determine the premium. They are gender, age, health, tobacco use, and the amount of the insurance benefit. With all those factors being the same, the premium will be different for each type of insurance. Why is that? It really boils down to the benefits and the levels of risk to the insurance company. Here's what I mean. Let's say our client is a 40-year-old man in standard good health, non-tobacco user, and we're looking at a $500,000 policy. So all those main cost factors are the same. Now, let's add that the mortality tables that the actuarials have determined set the life expectancy for this person at age 83. That is, on average, a person fitting this description is expected to live to age 83. And each type of insurance is offering a $500,000 of insurance benefit. A term policy is going to have the lowest premium. First, because a term policy is only for a relatively short period of time. The longest term a 40-year-old or younger person can buy is for a 30-year term. So the insurance company is only taking on the risk of that person dying for 30 years. And they're expected to live at least 40 years more. So that means there is a high probability that the insurance policy will terminate before the client dies, and therefore the insurance company will not have to pay any death benefit at all. This is the case in approximately 98% of all term policies. Low risk equals low cost of the contract or premium. Another thing with term insurance is there is no cash value to the policy. So when a person buys a term policy, they're basically paying for the peace of mind that should they die while the policy is in force, their beneficiary will receive a good sum of money, but the likelihood of that happening is very low. Of the three types of insurance, whole life will be the highest cost of premium. All the client factors are exactly the same, but with whole life, the policy does not terminate in 30 years or less. And remember, the mortality table says this person should live to be at least 83 years old. So that's at least 13 more years that the insurance company is carrying the risk of the client dying. And in fact, it's known that the client will eventually die, and the insurance company will have to pay out that $500,000 death benefit. Not only that, whole life has a guaranteed cash value benefit built in that provides a tax-free growth account that the owner of the policy can tap into by means of policy loans. So that means that for the contract to make sense for the insurance company, they have to know how much money they will have to collect from the client and invest in their portfolio of investments in order for them to gain enough profit to be able to not only pay out the death benefit when that time comes, but also to feed into that policy's cash value and still make a profit for the company. Now, with a universal policy, the premium is going to be somewhere between that of a term premium and the whole life premium. and usually a lot closer to that whole life premium. The question here is, why? If universal policies also take on the guaranteed risk of paying out the death benefit and have a cash value component to the policy, why is the premium any lower than the whole life policy? And this is the tricky part about universal policies. Universal policies can grow cash value, but it is not guaranteed as it is with whole life. Universal policies have a possible zero cash value growth, and with variable universal policies, they can actually lose cash value. Another tricky part about universal policies is that they are basically term policies with some cash value add-ons built into them. But they also have an increasing cost of insurance, just like term policies. So if the client doesn't voluntarily increase the premium they pay, the policy will likely lapse after 20 years or so. And there you have it, folks. So again, the four main factors that determine the cost of insurance premiums are gender, age, health, tobacco use, and size of the death benefit. Those factors determine the risk that the insurance company is taking on. And then it's a matter of how much will the insurance company have to collect from the client and invest in order to generate enough profit based on the law of large numbers and actuarial science. I hope this has been helpful for you. Please like this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is on the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to become a client of ours, the link to the application is below. We're here to help. We look forward to helping you. Aloha and mahalo for watching.